Hey there, welcome to today's episode where we simplify some important concepts about insurance contracts. Whether you're studying for an insurance exam or just curious about how insurance works, I've got you covered. Today we're diving into the special features of insurance contracts. What makes them unique compared to other types of contracts? By the end of this video, you'll have a clear understanding of terms like aleatory contracts, contracts of adhesion, and much more. Let's get started. First up, let's talk about aleatory contracts. What does this fancy term mean? Essentially, an aleatory contract involves an unequal exchange of value between the two parties. For example, let's say you pay a relatively small premium for life insurance, but if something happens, the insurer pays out a much larger benefit. Here's the catch. The insurer only pays benefits if a specific event happens, like an illness or death. If nothing happens, no benefits are paid. So the performance of the contract is based on an uncertain future event. Think of it like this. Insurance is a little like gambling, but legal. You pay a small amount, your premium, but the payout depends on what the future holds. Next, let's discuss contracts of adhesion. These are contracts prepared entirely by one party, the insurance company. The terms aren't negotiable. You, the applicant, either accept them as is or walk away. Because the insurer writes the contract, they are responsible for making sure the language is clear and free from ambiguities. Now, here's an interesting part. If the terms are unclear, courts typically side with the policyholder, not the insurer. This is based on something called the doctrine of reasonable expectations, a principle that ensures the policyholder gets what a reasonable person would expect from the contract. Insurance policies are also unilateral contracts, meaning only one party, the insurer, makes a legally enforceable promise. For example, the insurer promises to pay benefits if certain conditions are met, like a disability or death. On the other hand, you don't promise to keep paying premiums, but if you stop, the insurer has the right to cancel your coverage. It's one-sided but fair. Most insurance policies are personal contracts, meaning they cover the individual and not the property itself. For example, your auto insurance covers you as the driver of your car, not the car itself. That's why you can't transfer these policies to someone else when you sell your car or home. However, there's an exception: life insurance policies. These are not personal contracts and can be transferred to someone else through an assignment. This flexibility is why life insurance policyholders are often called policy owners. Another important feature is that insurance contracts are conditional contracts. This means that the insurer's promise to pay benefits is dependent on you meeting certain conditions. For example, you must pay your premiums on time and notify the insurer of a loss for the policy to remain valid. If these conditions aren't met, the insurer isn't obligated to pay. So, keeping up with the requirements is essential to maintain your coverage. Now let's break down the difference between valued contracts and indemnity contracts. Valued contracts pay a predetermined amount, regardless of the actual loss. For example, a $500,000 life insurance policy pays that amount when the insured passes away, no matter what. Indemnity contracts, on the other hand, reimburse you for actual losses. Think of medical insurance that covers your hospital bill. If the bill is $25,000, the insurer pays exactly that amount, minus any deductibles. Finally, let's talk about insurable interest. This is the financial interest a person must have to buy an insurance policy. For example, you have an insurable interest in your own life, your spouse's life, and even your business partner's life. But you don't have an insurable interest in, say, your mail carrier, because their continued life doesn't affect you financially. The key here is that insurable interest only needs to exist when you apply for the policy. So, if you divorce your spouse but keep the life insurance policy you have on them, it's still valid because insurable interest existed at the time of purchase. And there you have it. The special features of insurance contracts explained in a simple and easy-to-understand way. Remember these key points. Aleatory contracts involve unequal exchanges. Contracts of adhesion are non-negotiable. Insurance policies are unilateral and personal, except for life insurance. They're also conditional, and some are valued while others are indemnity-based. Lastly, insurable interest is crucial when buying a policy. If you found this helpful, give this video a thumbs up and subscribe for more content like this. Thanks for watching, and I'll see you in the next video.